Hey, good morning, my friends. Today is Tuesday, October 29th, 2024. I, of course, am with Originator Success here with your daily mortgage rate update. The only place on the web where you guys get to join me live each and every weekday morning, 9:30 a.m. Eastern Time. Like hot coffee, this show is best imbibed when it's fresh. So make sure you join me live 9:30 a.m. Eastern Time, broadcasted to you on Facebook and on YouTube. If you're watching on the replay, don't worry. I love you too, especially those of you on the West Coast. I know it's early. So if you're watching the replay, don't forget in the comments to go ahead and give me a hashtag replay. Also, anything that we're chatting about, go ahead and throw your 2 cents in there. We'd love to hear it. So if you want, you can also jump ahead a little bit if you'd like. Now, remember, go ahead and smash that like button, tag an LO friend, share this post in a group. Help us to grow this thing. Also, you can sign up for our free email lock advice. I send an email out each and every weekday morning, www.ratelockadvice.com. Unfortunately, they haven't been reading very well lately. They've been painful, but I'm just the messenger, my friends. Also, you can sign up for our text alerts, www.ratetextalerts.com. We send you out a morning text, an afternoon wrap-up texts, and then alerts when reprices worse are prevalent. Yesterday, we did save quite a few people from some pain. I got a couple of reply text messages thanking me for people that were locking in yesterday before the reprices worse. Who'd have thought that yesterday was going to get reprices worse? Oh, wait. I said reprice worse was moderate. And today it's going to be the same thing. So check out our text alerts. Also, if you want to be reminded that I'm going live so you can jump on each and every weekday morning, that text is free of charge. I'll bug you for free anytime you want. hmmr.io/reminder. And last but not least, check us out at originatorssuccess.com. Although I love talking about rates and pricing each and every weekday morning, what we do here at Originator Success, we help you to generate business. And I got to tell you something, with rates going where they're going, with the outlook changing as drastically as it has, you got to have all your business pieces dialed in. So we're here to do that for you. Originatorssuccess.com. Go ahead and check us out. So with that said, I always like to start my mornings by saying hello to all of my friends that are here live. So let's go ahead and say hi to my friends that are here live. James Mahan, good to see you, sir, over there on YouTube. Hope all is well in your world. Monica Dinkins, good morning. Amy Blauser, someone at Best Rate Mortgage, good morning from YouTube. Megan Lindbergh, good morning. Angela Walters, hello, and thank you for joining us. Colin Jordan. Colin, how are you enjoying the show so far? You're a fairly new watcher, imbiber, so curious to hear your take on it. Greg Donald Wilcox, mortgage real estate investor. Hope your world is doing well, my friend. Greg Wilcox, are you a mortgage person? Do you write loans for people? Or are you actually a real estate investor? Or do you do both? Mike Schmolgen, good morning, sir. Rob Stewart, great to have you here, my friend. Bill Stevens, how are you? Great to see you, sir. Tom Stafford, good morning. Almir Kridvik, good morning, sir. Mallory Fotiadis, always a pleasure. Let's see, Chris Burleson, Sean Leland, great to have you here. Ron Siegel says, all right, everybody, take it seriously. This morning is National Oatmeal Day. And if you've already eaten your oatmeal, I've got bad news for you. Pricing this morning is going to make you sick. So we'll talk about that in a minute. Jeremy Lowe, good morning. Dude, I know you need great news. I do not have great news for you. I have more bad news. I am just like that friend that points out all the negative things in the world. I am so sorry, but yeah, that's who I am today. More bad news. Tim Klyla, good morning, sir. Greta Chene, good morning. Tim said, WTF is right. Those of you that get my morning text, we went from bad to worse, from worse to what the frankincense. Greg, you do both. That's very cool. So, all right, my friends. Well, thank you again for joining me this morning. So glad to have all of you here. Ron Siegel says, great news on the horizon. If what, Ron? Don't keep us in suspense. Colin said, since I started watching consistently, the rates have continued to climb. Maybe I'm bad luck. I don't think it's you, dude. Good morning, Benoit. Great to have you here. All right, so let's go ahead and get on to the other screens here. I have been in a locking stance like very consistently for quite a while, and here's why. You could see, look at this trend. We started out up here in September, and since then, I was floating through the first leg down, right? But then after we got to that labor market data and we got whacked in the head, it looked like, hey, maybe we get a little bit of reprieve. And then since then, it has just been a landslide. There have been no technicals that have held up, that have been able to hold up through all this damage. Same thing over here with the 10-year treasury yield. 10-year treasury yield up to 4.33. You could say 4.5. Here we come. It is absolutely coming. Look at the way that this 10-year treasury yield has just climbed. And when we put this in perspective, actually, you know what? Let's look at the big chart here. Let's change this over to the 10-year for a minute and look at this. Look at the perspective. Let's do this for a year. Look at what happened here, right? We spent all of this time going down, and in the course of from September 17th to October 29th, so we've got roughly 6 weeks here, we have retraced and lost so much ground. All of the ground. Remember back here in July when we first got the news that the Fed was going to go ahead and start cutting rates, and markets were starting to price that in. Take a look here. In July, we were back up with the 10-year up in that same area that we're at now, 4.25. Let's just call it 4.25, 4.25, maybe even a little bit higher, right? And then look at how this dropped down in yield after the expectation Fed's going to cut rates, and look at how low it's gone. We are now back above all of that. We are bypassing all of that. Hopefully we will not see anything near back here. See this? We could just barely, this is October of 2023, right? Oh my goodness. My years are mixed up at this point. 2023. So this is how bad we were back in October of 2023. We were at 4.89. So 4.89, 4.93. We were almost at 5. We're at 4.32 and climbing. These were the worst rates we had seen. These were the 8s, right? We are now back firmly in the 7s. Again, this 10-year treasury yield just telling the story of a huge, huge turnaround in perspective. We'll put this down to 3 months now so we can see it here. Look at this. Is just a huge turnaround in perspective on what is going on in the markets. Now, I know that especially right now, consumers not loving any of this news. LOs, of course, not loving it at all, but agents and consumers are going nuts. Ron is talking about some technicals here. Let's talk technicals, Ron. Ron said Goldman Sachs is forecasting 3.85 10-year by the end of the year. I sure hope Goldman Sachs is correct. And you know as well as anybody, we could see a huge pivot. We'll talk about what could be the pivot there. Tim is asking, is there any level of support? Or are we in no man's land? Well, all right, let me go ahead and point this out. I know some of you, this is kind of old hat, but some of you are not as familiar with this stuff. We have the technicals, all these fancy charts over here that we've got going on the other side of the screen. These charts are the technicals. So when we look at like, hey, are we in a support level? We could look at Fibonacci's, we could look at other things, but notice I haven't talked a lot about that. Why? Because the other part of the equation is fundamentals. Fundamentals are the events, the data that are happening outside of the technicals. Traders will trade technicals, but they'll also be trading and factoring in fundamentals. What are the fundamentals we got going on? We got jobs data this week. JOLTS data coming up in 20 minutes. We've got the big BLS, jobs data coming on Friday. We've got the election coming on Tuesday, November 5th. And then we've got the Fed meeting that comes out on November 7th. We have a lot of fundamental data coming in. So, Tim, I'm not putting any credibility on any of the technicals because traders are not going to put a tremendous amount of stock on it. What the technicals are going to do, they're going to trigger automated sell-offs. They're going to, you'll see a one-day behavior, some pullback. Like when we see that the 10-year has totally washed like it has here, you'll see a day of green where they start to consolidate that a little bit. Let's go back over here and do mortgage-backed securities. Okay, so looking at mortgage-backed securities, and let me put my head down at the bottom of the screen so that you guys can see this, right? So looking at MBS, hold on, I gotta just make this a little smaller so that it goes above your comment. There you go. Okay. So looking at mortgage-backed securities here, the way that we've gotten this, we could see a day of green where you'll get like this, but then it just goes down again. So there's so much going on there. Now, Mike Morano said next closing is 11/7. Any good news next week? Yeah, dude, no. I would have that thing locked up because there's just too much potential to see rates jump a half a point. I mean, if the jobs data comes in super weak, I don't think we see enough of a turnaround here. This is like trying to jump in front of a locomotive. I mean, you're not going to stop this speeding train. Even if with a car, you put a car in front of a train, you got a good movie scene. It's just going to annihilate it. Ron says significant resistance at 4.37. And do not be surprised by responsive buying as the Bears approach 4.37. So, Tim, that's kind of the answer to your question. The technicals over here with 4.37, but I don't think that that's going to hold up. I think we're going to blast off to 4.5, especially if that jobs data this week shows any kind of strength at all. Good morning, Don Elbert and Dan Crowley. Great to have both of you here. So, unfortunate, again, just a lot of negative going on with this stuff. Ron says the Fed meeting will be interesting. Now they say they're discounting the accuracy of the BLS in lieu of what the 12 districts are seeing. Sticking to the 50 basis point cut forecast, you are definitely on an island. But let's take a look together. Let's take a look and see what is forecast for the Fed activity and where do we go from here. So taking a look here, we'll take a look together. Right now, markets are pricing in a 96.3% expectation of a quarter point cut. There is nobody but the outlier Ron Siegel expecting to see a half a point rate cut. And 3.7 believe there'll be no cut at all. It's almost everybody. Good morning, Julie. It's almost everybody that is betting that the Fed is going to cut rates by a quarter point at this meeting, that it's a pre-done deal. Now, in December, we saw that we're back below 70% expectation that we'll get another quarter point cut. And there's about a 30% expectation that we will stay the same in December. As we get into January's numbers and look and see, there's a split between whether we'll see a Fed funds rate at 4.25% or 4%. Again, that really comes down to how many believe we're going to see a cut here versus how many see a cut here. It starts to disappear as we get into March. We're seeing that it's, their markets are still believing that that we're going to get back on track and that the Fed is going to cut. I don't know if that's accurate or not. I can't say. I don't know the future. What I will say is we need to see a big reversal in data to see that happen. We would need to see this jobs data come in helpful. The December 6th jobs data is going to have to come in light. The good news is that historically in October, after we have these terrible months of October, we tend to see a reversal and a pullback in November. We're especially set up for that this time around because the election, because of the Fed meeting. So we could see a lot more positive recovery in November, but it's not going to bring us back. Consumers, they have to come to terms with where we're at. I mean, Mortgage News Daily now bringing on the big bad 7%. You guys have been quoting rates in the sevens for a while now. The reality is that we were at 6.11 on September 15th, and now we're at 7%. We're basically jumped a full point in less than a month. Rates have jumped a point. Consumers don't like that. It's not going to bode well. It's going to be painful, especially as we go into the holidays and things get quiet. So you've got to make sure your activities are dialed in. But anyway, that's not what this call is about. But the focus here, we're going to see rates continue to move higher. There's just too much risk. How low can it go? How bad can it get? Well, again, if we look at this and we do like for the 5-year, and we take a peek here. Oh, no, it won't let me. Hold on a minute. There you go. So looking here at like the 5-year idea, you could see where we're at right here. This is where we were back in October of 2023. It was much worse a year ago. And this was the worst rates that we saw. This was the absolute, these were the 8s. Right. And for conventional conforming rates in the 8s, that was the worst that we saw. What we probably see is going back to where we were earlier this year, though, in April would be more likely. That would be more of what we're probably likely to see this year going on, would be that move here to April levels. This here is, June, which is kind of where we're at now. Hopefully we could see a reversal. If I were to take this And I know it's not super big, but let's just go ahead and do this for you here. All right. If we go ahead and draw a line here, and we're basically, we're putting this line right here, because that's, the point where we were. You could see that we're coming down, and you could put a technical support line here for mortgage-backed securities and get a bounce. But the question becomes, how bad will it get? And if we get a bounce here, where is that? That is roughly, let's see, that is roughly around like 98.30, 98.50. It's not tremendous. 90, yeah, 90. Yeah, so 98's it's lower than it is now, but not much lower. We're almost there, is what you could see here. If you want to, kind of look at this as where we were back here in April, back here in June. That's been a line in the sand. And after such a severe sell-off, we could see a bounce here depending on what happens at the Fed meeting. So that's kind of what we're hoping to see. But it could get worse from here until then. Let's see. Ron says, if Harris wins, there will be a big shift since the market's been trading, assuming a Trump win, and will need to shift to Harris's policy. Yes and no. I know what you're saying, and I kind of agree on that, but I think it was in the print version yesterday. There was a good article here in the Wall Street Journal about, either whichever one wins, we're looking at more debt. And that, Ron, that's going to be the big thing. It's not just like the tariffs get all the headlines, but the reality is that markets believe that either one of them are going to put us deeper in debt. More treasuries issued, more supply drives yields, blah, blah, blah. So we've got all that on there. Ron said, I think the election is already factored in. Markets believe Trump will win, and they're trading to support that thought. It's possible. You could argue that the Trump trade is because of the tariffs. That's what a lot of the articles always talk about. And that it's, going to be like inflationary. It's going to create more inflation. I don't know that I necessarily agree with that, though. Good morning, Yasmin. Good morning, Tom Dedmore. Good morning, Jessica Wells. Austin Smith. Great to see all of you. So, all right, y'all. Unfortunately, that is going to be the end of our time today. I'm going to wrap it up. Again, the reality, we're going to get the JOLTS data in a few minutes, and that could make things even worse. We could see reprice risk on the day. I have all these things, and I didn't even pop them on the screen. So let's do that. So quick recap, what happened yesterday. Actually, I'm going to change to this and do it. Quick recap, what happened yesterday. Bonds started out flat, quickly lost ground after morning rate sheets came out, triggered a landslide of reprices worse through the early afternoon. That's why we sent out a reprice alert yesterday. Markets are preparing for the 10-year to pass 4.5 again, and it may not take long to happen. There's mounting concern that borrowing is going to increase next year, driving up yields. That was what I was talking about, Ron, where it doesn't matter who wins. They think we're going to be borrowing. Risks continue to favor locking most loans. Only loans that are the farthest out would still be floating. Rate sheets today are going to be worse. Bonds already losing ground. We haven't even gotten the JOLTS data or consumer confidence data yet. That could push things even worse. Right now, mortgage-backed securities are down 16 basis points on the morning. We could double that if the JOLTS data comes in considered strong. Reprice risk on the day is moderate. I mean, it may even it's not high because the JOLTS data is going to come out at 10 a.m. and it'll hit morning rate sheets. So we've already seen day after day of bonds just slipping with lenders repricing worse, and the outlook is ugly. It's all bad at this point. I mean, it really is. We have such a devastating reversal. Here I was having a parade 6 weeks ago about the worst is behind us and rates are going to be better. And now here we are back in the sevens. I mean, how wrong could a guy be? But I can only tell you what's going on in the markets. I can't tell you, I can't forecast what's going to happen in 6 weeks. This is just weird. This is just bad. This is just crazy stuff going on. So as Bill Stevens said, stay strong, our friends. And I will see you tomorrow. Right. So, hopefully you guys are just keep your nose down, keep your head down, grind forward. We'll get through this rough patch. It is a patch. So, and then we'll finish up. So, all right. I'll see you tomorrow. Take care, everybody.